In this video, we will answer what is risk premium, how does risk premium affect asset prices, and how risk premium fluctuates over time. Risk premium is the extra return that is offered to someone with cash to purchase an asset with market risk. Cash can be spent today, used to pay off debt, saved in a bank, money market account, or saved under your mattress. An asset that has market risk is not cash. When the asset is purchased, it can change in value tomorrow while cash won't change. The reason why assets require a higher expected return is because of this feature/bug. That is a good question. It's about expectations. At this very moment, all assets have a risk premium. Every asset is currently owned by someone, and that person thinks that asset will go up in value. We can't know which assets will go up. If we did, everyone would move to those assets and push up the price. But as of this very moment, all future expectations for assets are priced in for this discussion. Sure, some assets will go up and some will go down based on changes in fundamental economic outcomes and expectation of changes. But what is important is that despite these moves, things that go down less, and things that go up more because they collect risk premium. The next question is, how much risk premium does each asset get? Firstly, it depends on the riskiness of the asset. The less market risk, the less risk premium. A 1-year treasury will have very little risk, and a meme stock will have a lot. This simple concept is that all assets should have the same risk-adjusted return. In other words, a higher risk asset should have a higher risk expected return than a lower risk asset. The expected return should scale linearly with the risk. If this was not true and one could generate higher risk-adjusted returns in a specific asset, money would flow into that asset, arbitraging away the excess. It is important to realize that all assets have a return that is greater than the return on cash, because they carry market risk and no one would purchase them with cash if they had a negative expected return against cash. So far, I have stated that all assets have a risk premium and that risk premium scales with market risk, and that the expected risk-adjusted return of all assets is the same. Before I address what influences the level of risk-adjusted return, I'll mention that what I mean by risk is amorphous. However, it is some combination of future expected volatility and future drawdown risk. But I don't really know, so it's just a concept for now. What drives the level of risk premium, you may ask? The level of market-wide risk premium is driven by the availability of cash, money, and credit versus the supply of assets, which includes real and financial assets. When cash is plentiful and issuers of debt and equity need very little cash, risk premiums tend to be low, which is what we saw through quantitative easing from the COVID pandemic. When cash is tight and/or issuers are looking to sell a lot of debt, equity risk premiums tend to be high, which is what we are seeing now with quantitative tightening and the rate hikes as much as 75 basis points at a time. For equity traders, risk premium is inverse to multiples. Higher risk premiums equal lower multiples. For you credit traders, risk premiums are directly related to credit spreads. Rates traders, risk premiums are embedded in both real rate products and nominal rate product yields. When Damp Spring tracks risk premiums, we focus on both the availability of money and the availability of credit, which includes Fed purchases, and the supply of assets, which includes government debt. Also, who gets the cash when debt or equity is issued, and what they do with the money is an important question for next time. That's been your 5-minute finance lesson. Thank you for listening.